Thank you, everybody, for coming back so quickly after the break, and great to be here. I think this session actually follows on brilliantly from the panel which we had before break, and I'm really excited to talk about the topic of the conversation is what's in your portfolio. So before the break, we were talking about real-world assets. We were talking about cryptocurrencies. We were talking about different types of what you might be putting into what people might start to invest in. So on this session, instead, we'll be now looking at what a portfolio might actually look like. And to take us through this conversation, I have a brilliant panel with me on stage, which I'm really looking forward to. We're going to first kick off. And I'm going to ask the panel members to introduce themselves shortly. But just to give you an idea of who we got here, we've got Jim Angel, who's joined us from Georgetown University. Jim is actually going to kick off the session first with a few slides, giving some background and actually positioning what we're going to talk a little bit more about for about sort of 5 to 7 minutes or so. Then we're going to go on to the rest of the panel, and to join Jim on the panel, we have Colin from Outer Lens Capital, we have Conrad from Galaxy, and we have Aaron from Vanek, who didn't have to walk very far to join us here today.
Correct.
But we're very pleased that everybody's here with us. So Jim, should we hand over to you first to do a little bit of an introduction of yourself, and then maybe kick off your slides, and then we can have the rest of the panel members introduce themselves after you've done your intro. Is that okay?
Happy to. My name is Jim Angel. I'm a finance professor at Georgetown University, and I've done a bunch of professorial things over the years. I basically study what markets do, and one of my claims to fame is that I was part of the friend of the court brief that helped convince the US SEC, or helped convince the court to force the US SEC to allow Bitcoin ETFs. Okay, but what I'm going to do to set up the rest of the panel is talk a little bit about the history of institutional investment, how investors think, and then tee up, where does blockchain fit in? And to give you a hint as to where we're going, I'm going to talk about everything from herd instincts, booms and busts, give you a little bit of an intro to an investments 101 of like how we teach investors to think. Yeah, it's my fault. And then get into where do all these exciting new technologies fit in our portfolios? Well, as Paul pointed out earlier, in the old days, institutional investors basically invested in bonds, government bonds, railroad bonds, really safe assets. Yeah, right. To a certain extent, they were actually limited by laws and regulations as to what a fiduciary could do. Well, around the middle of the 20th century, we started to wake up. Modern portfolio theory began to arise, and we learned about the benefits of diversification. I'll talk more about that in a moment. But also, computers came in, and we were able to actually do the calculations to show that, wow, equities had a high enough return to compensate for the risk. Wow. So institutions gradually began shifting into equities. And I'm envious of the slide that Paul had. So just visualize that one in your head. By the end of the 20th century, the diversification argument kept on going, and international diversification became not just an exception, but expected of well-managed institutional investments. Also, we saw the rise of indexing and the birth of ETFs. And here in the 21st century, we have this continuing search for assets with low correlation and high expected returns wherever we can find them, or as we say, so-called alts, or alternative investments other than just stocks and bonds. But one thing to remember about the way we humans invest is we're social animals. We tend to follow the herd. And there's a saying in asset management, the way to keep your job as an asset manager is don't come in last. So institutions tend to follow each other. There are real incentives for mediocrity there, believe it or not, because they're scared of what happens if you deviate from the herd. If you deviate the herd and you're ahead of the herd, you're a winner, you're a hero. If you're in the middle of the herd, you earn a good living. If you're behind the herd, you're in trouble. So, there's definitely this fear of doing something different, and also concerns about the custody of crypto assets. But, as you know, we humans get carried away. Here we have a slide of the Gartner hype cycle, which talks about how when you have a new technology, there's a trigger. We have a peak of inflated expectations, a trough of disillusionment, and finally, enlightenment and productivity. And we've definitely seen this in the blockchain and crypto space. We've seen this over and over and over again in financial markets. Here in Amsterdam, the tulips are coming into bloom, and it reminds us of tulip mania nearly 400 years ago. But we also know that money attracts thieves, just like garbage attracts flies. And when you have a new technology which isn't properly regulated yet, you get a lot of problems. Here is a woodcut talking about the days of the South Seas bubble, when there was a wave of initial public offerings of that brand new technology called the joint stock company, and many of them were scams. When the ICOs came out, we had this great new technology of raising capital around the world, and many of them, if not most, were scams. And we see this happening over and over again. It's the way we humans behave, whether it was the South Seas bubble or the dot-com bubble or Terra and Luna. This is human nature. Now, in terms of thinking, we like return, and we hate downside risk, the risk of losing money, and we usually measure that as standard deviation. But one of the things we know is diversification reduces risk. So if you have less correlated assets, that reduces your risk. So here we have a chart that you see in just about every introductory finance course, which shows that as you increase the number of stocks in a portfolio, the risk goes down, but it doesn't all go away. So you can get rid of some risk, but not all of it. So there's always a search for less correlated assets. Now, where do blockchain-related or crypto assets come in? Well, the market has been treating them like tech stocks. There are a lot of technology companies that trade in our markets, which may be worthless or may be the next cure for some awful disease. And you'll notice that here we have a chart of the rolling correlations between Bitcoin, or more precisely a Bitcoin trust, and the S&P 500 index. And you can see that in recent years, the correlation, which used to be really low, is now significantly high because indeed, from a portfolio perspective, the market is treating Bitcoin like another tech stock. But when we talk about investments, it's very important to realize investors make money in different ways. That some investors, like Warren Buffett, have a time horizon of years. They're looking at the fundamental cash flows. But you know what? Most investors don't have the luxury of years. Most mutual funds and hedge funds have investors that can whack out the door in days or weeks. So what do? They have to speculate on what will be popular in the near future. If they can't do that well, they're out of a job. Others, the technicians, are looking at days and hours. They're speculating on how the crowd is going to move in the next few minutes or days. Market makers provide a service. They're thinking about minutes. And the arbitrageurs in milliseconds. So what does this mean for investors? Well, we're all searching for assets with high returns, reasonable risk, and a low correlation with the rest of the portfolio. And there's that tremendous search for things that are new that other people haven't discovered yet. And this is why tokenization of assets that are currently unavailable to most investors are going to open up new investment opportunities. Now, we've been tokenizing assets for over 400 years. A stock certificate is really just a token of ownership, transferred on paper ledgers, paper databases, decentralized paper databases. Okay? Now we've created digital bearer assets with really wonderful technological properties, that can revolutionize our markets. So we're going to see more things that become available. But how much of them should be in the portfolio? Well, portfolio theory says estimate the return, estimate the risk, estimate the correlation. That's hard to do. But if you can't beat them, if you can't do the math, which is hard to do, you can do what everybody else does. And this is why we have so many people in index-based investing. Depending on how you measure it, it's anywhere from 16% to over a third of US market cap. Now, what this means is once blockchain assets, I don't like the word crypto, once blockchain assets become part of the market portfolio, index-based investors will want and need them, but we need a clear legal and regulatory framework to permit everybody to join in. Now, one more slide for you, then I'll turn it back over to G. First of all, blockchain or crypto is not a single asset class. It's like saying paper-based assets are a single asset class. They're not. So many different things can have their ownership recorded and transferred and transformed on a blockchain with very different economic characteristics. Whether they're stable things like stable coins or worthless shit coins or meme coins or smart contracts. There's so many different things that they're not all alike. But the long-term winners will be the ones that provide long-term benefits. So basically, the question to ask is, hey, when I look at a particular asset, why will somebody be willing to pay more for this asset in the future? But again, we do need a stable regulatory scheme to protect us all from the next FTX. Jeet.
Thank you very much, Jim. Thank you for that introduction to what we're going to cover. So, reminding everybody about Paul's proviso right at the beginning, we are not here to offer any investment advice. And therefore, none of this is any investment advice. We are having a conversation. Panel members, it would be great now if you could introduce yourselves, and let's then talk about how big or small you think this should now be in your portfolio. And I wonder whether we should kick off with Colin. Colin, do you want to just quickly introduce yourselves and then maybe talk about how this would look in your portfolio?
Yeah, sure. So Colin Jones, I run Outer Lands Capital, which is a relatively new digital asset manager. But I formerly had 15 years in academia, most recently at the University of Notre Dame. So I was a finance professor that got infected with the crypto bug when a student walked into my office in 2013 and asked if I knew what Bitcoin was. He was using it for purposes that we'll look past. I was fascinated by the technology and the ability to transfer value peer-to-peer. Read the white paper, went down the rabbit hole, as people like to say. Ethereum came out in 2015. My head exploded. Smart contracting, programmable money, amazing stuff. I started teaching classes on it in 2016. And then in 2021, was, I guess for lack of a better word, getting bored of academia and getting very excited by what was going on in the crypto landscape, and left academia, joined Horizon Labs, which was a blockchain development company specializing in zero-knowledge proofs, which we may end up talking about eventually. Built the investments team there, and we did a whole lot of stuff from advising Fortune 100 companies on tokenomics models, because in 2021 everybody wanted to launch a token or an NFT project or something, so saw a lot of the use cases there. We were investing the balance sheet, generating yield, and we started looking around the landscape, and all of these things that we learn in academia, diversification, risk mitigation, seem to be absent in a lot of the fund managers that we saw in the space, and we're very passionate about the technology. We think blockchain is going to change the world. I think it already has started. And we didn't see managers that were putting together diversified baskets of digital assets that would slot nicely into an institutional portfolio. So we spun out the team with Horizon Labs support in 2023 to try to bring diversified, thoughtful, evidence-driven portfolios of digital assets. into institutional portfolios. So that's what we do on our day job. But I think the really interesting theme here is you should have some digital assets in your portfolio. This is like an amazing technology, a narrow technology with very wide applications. Why wouldn't you want to be on the right side of disruption here? You should have some percentage of your portfolio in digital assets. But it's really going to be the convergence of traditional finance with digital assets. So what do we mean when I say crypto today or digital assets right now? We're talking about some sort of decentralized network business, some sort of DeFi project, some sort of decentralized application that's running on an L1 or an L2 or some scaling solutions, the infrastructure, the rails. But the entire financial system is going to get replatformed over to these rails. And then what are we talking about? You can buy stocks, you can buy bonds, you can buy real estate, you can buy tokenized private assets, you can buy tokenized funds, all on digital asset rails. So now asset management just all moves over to crypto. And so now it's this convergence of all the traditional financial assets with what I today refer to as crypto assets, and your entire portfolio will be digital assets. So I think that's like a really interesting convergence that's going to happen, and I think we can talk about what that's going to enable for individual portfolios and what that means for the future of wealth management, for asset management. Fractionalization and tokenization of all financial assets is going to enable portfolios that are, I don't even think we can comprehend the way that it's going to change stuff, but it's not going to be a 60-40 portfolio. That has died, and I think the future of asset management and wealth management will be much more diversified across a lot of asset classes.
Brilliant. And we've coined the phrase actually at EY Markets 3.0 to talk about the future of what that potential financial infrastructure might mean and what that might actually allow us to do in the future in terms of portfolios. And I think countries like Singapore have been doing some really clever stuff with their potential level 0 as well, that they're suggesting that will allow them to do some funky stuff there. Given all of that, Conrad, we're just going to go over to you. How does Galaxy fit into all of this? What are you guys doing in the space? What's your thinking? What's in your portfolio, dare I ask?
Yeah, no, awesome. Thanks very much for having me. I've seen a lot of familiar faces in the room, so for anyone who hasn't come across me or Galaxy, we're like a one-stop shop set up to service institutions and make it easy for them to get access to crypto asset class and crypto assets. We have 3 lines of businesses, pretty much a coin business where we help counterparties add risk, hedge risk, borrow and lend finance assets, where we basically enable managers who want to insource the investment management decision with getting exposure. We have an asset management business where we basically enable people who want to outsource and get exposure to the asset class with active, passive, illiquid slices of risk. And then increasingly, we're building out the infrastructure business, proving, sequencing, staking services, as well as tokenization to help people really get involved in the nuts and bolts of the technology, right? I think interestingly, Christoph mentioned earlier, Colin alluded to this, how much is it going to be, are people going to hold in crypto? It depends on what is going to be crypto. I do agree that there'll be conversions with assets moving from off-chain to on-chain. If I think about my cohort, even my parents by now, in terms of path of travel, it was banks only. They come and visit me in the UK, they're based in Germany. Before you know it, they get a Revolut account. That's one-click distribution to crypto. Wiring monies, all becomes very simple and streamlined. And then crypto is just one step away, right? And then in today's market environment, the real question is like, what is crypto? And I think Paul mentioned it quite succinctly in the first kind of session, was like, you have Bitcoin as the gold standard in terms of the asset. The rest, to some extent, needs to be figured out. Is this a utility coin? Is it a fuel? Is it something else? Is it a security token potentially? But that is all being digested in the ecosystem. Path of travel is we're seeing more and more of that adoption. And then the real question, when this comes into the tokenization, with the fund format, real world assets on-chain, is it going to be single assets or is it going to be fund products which are going to move on-chain? And do you, as the investor, want to have directional exposure to crypto or market neutral exposure to crypto?
Thank you. And Aaron from VanEck, how does this fit in with you, and how do you see crypto in your portfolio?
Yeah, maybe as a quick intro. So my name is Aaron. I'm head of investments for VanEck in Europe. We are, for the ones that don't know us, we are a global asset manager. 130 billion in assets is that we manage. In Europe, that's about 18. We are mainly known for ETFs, the ETFs that we issue. We are, let's say, big enthusiasts of blockchain technology. I think we were one of the first traditional asset managers to look into crypto, to look at blockchain technology, to look at launching a Bitcoin ETF. We only were able to do that, I think, a year ago in the US, and we were a little bit more lucky in Europe when we were able to launch Bitcoin ETNs, exchange-traded notes, in 2020. We also now have Ethereum, Solana, Sui, and a few baskets. And I think maybe coming back to your point, because I think it was one of the last slides where you said, okay, if we want a real adoption in digital assets, they need to be included in indices, right? Well, that's something I acknowledge, of course, which I like. And the thing is that, and this may sound a little bit counterintuitive, but with these exchange-traded notes that we currently have, so we're invested in Bitcoin, Ethereum, we have two baskets that are basically invested in just a handful of digital assets. Yep. The weird thing is that our current two baskets that we have only have 5 to 10 coins in there. Why is that? Because, and this again, it sounds very weird, but it's very hard to buy and settle them. And for some reason, it's very hard to connect the digital ecosystem with the traditional finance one. And that's why we are currently thinking, okay, what's the best way to move forward? How are we going to invest in digital assets? And what we're probably going to do is, as a first step, is tokenizing our existing investment vehicles. We want to get to that full on-chain economy. We really believe this is going to revolutionize, like you guys said, the financial ecosystem. And as a first step, we will tokenize our existing investment vehicles. Then what we would also need is cash to be on-chain and that we can really use to settle securities, right? Because that's still a problem. We have a lot of stablecoins out there and they are also very big, but we can't use them. And I'm now talking about the regulated framework. I think a lot of these digital assets that we talk about will be digital securities, or let's say tokenized securities, I should say. And I think that's super interesting to think about, right? As the industry, together with regulators, we need to sit together and, well, define this framework of what we think it's going to look like. And I mean, this is absolutely fascinating to think about, how this is operationally going to impact us, how it's going to change the investor's experience, and maybe how this all will play out is like, because in the end we need some killer finance apps as well. And what it might look at, for example, is that, I don't know, we have this beautiful app which serves as a tech layer. Individual investors would be onboarded. We also would have investment advisors on that app. The individual investors, for example, would, I don't know, put these investment advisors into competition, find the right one, and then maybe what happens is that these or investment advisors on the fly would create, in a very automated way, all done by smart contracts, very detailed, tailored portfolios for all these clients, and again, on the fly, within seconds. And then maybe what you will see, and that will be important for us as an asset manager, maybe what then happens is some sort of a bidding contest, whereby asset managers like VanEck, I don't know, Galaxy, would be put in competition to provide the best building blocks for this particular portfolio. And again, all in smart contracts in an automated way. And that's the direction we need to think of, how this could evolve, and what kind of impact this will have. Because even... and again, I'm an ETF guy, so our business is all about, let's say, efficiencies, operational efficiencies, and that's also why blockchain tech is so interesting to me. But how this will play out from an operational perspective is interesting to think about, and we should think about this, right? Because, and for example, think about something as simple as a dividend. Mm-hmm. We are now used to receive it on a semi-annual basis, annual, whatever. But what if with blockchain technology, companies will be paying streaming dividends on a continuous basis by the second? And as an investor, you would have full clarity on where the revenue is coming from. That's pretty cool, but it also means that the way we need to manage a portfolio will be completely different. We need to do this with smart contracts in an automated way. Another thing, we actually had an interesting discussion in the office a couple weeks ago. As an ETF provider, a big week for us is when we rebalance the indices. And nowadays, that's actually done in a very static way. The index says, okay, third Friday of March, at the closing of these markets, we will rebalance the portfolio. Maybe in 10 years' time, whatever, we would all argue, holy, how could we have done it like that, you know? Because maybe it's way better to do it in a dynamic way, over a 2-week period, according to a VWAP, whatever. We can already do that now as an asset manager, but this index that we track, I can tell you one thing, it will be completely impossible for them to calculate it like that. So this all needs to be done on-chain in the end. And this is where it's getting really interesting, right? And I don't know how much time I have left, if I can give maybe one more example. And I have to admit, I need to give credits to someone else about this example, but I think it's the perfect one that shows you what blockchain technology can do in the end to our whole financial ecosystem. And that's, let's assume a car manufacturer. To run their business, right, they need to attract capital, they need to, I don't know, hire a very expensive investment bank. They might hire you as well for advice, pretty costly too. And then
Worth it though.
yeah. And then this investment bank would issue a bond, I don't know, once a year, a couple times a year. But what if with blockchain technology it becomes possible for this company to, on the fly, issue a very small loan to buy or to produce a particular car seconds before they start producing it. And then that at the end of the process, I don't know, a couple hours later, they would immediately repay the loan. Let's call it an ultra or a short-term intraday corporate bond. And maybe even the buyer of the car would have had the option to finance this loan upfront themselves in return for a big discount on the car price. And I mean, this is how we need to think about this whole on-chain digital economy can evolve, and also what kind of impact that would have on asset management. Because if you look at, well, an ETF is already pretty lean and mean, and we need to operate or automate a lot of our processes. But I can tell you one thing, if we would have to manage these types of assets, and these are just existing assets, right? They move way quicker. It would be totally impossible for us to do that. And that's, again, yeah, then we need to think about, okay, maybe we can talk about it later, how's that going to look like? Well, maybe we would be managing an on-chain portfolio, and the portfolio manager would allocate, I don't know, 1% to an AI trading bot or an AI portfolio management bot. Exactly, that would trade this in an automated way for the portfolio. And I mean, I really love to think about how this is going to work out, and it will take some time before we get there. But questions like, who's owning this bot? Is it VanEck? Is it a specialized on-chain risk manager? Who knows?
And I think that's a really interesting question, because actually in the future, if you do tokenize everything and put it together, you could imagine people coming together as DAOs in groups, and what happens to funds. And dare I ask a group of asset managers, what happens to the asset manager? Where's your value? How are you going to add value in that sort of world, and how are you going to price your products? I mean, Colin or Jim, actually, before we go back to the panel, what are your reflections on what we've just spoken on, and what do you actually see as these future challenges? You took us back to 1637, I believe, earlier on. If we now just even roll forward 10 years from where we are now, what do you see as some of these challenges, sir?
All of the above. On the investment side, I think we're going to see a lot more direct indexing by individuals, in that we have the technology now with low-cost commissions to actually have individuals holding very, very large portfolios. So to that extent, where the fund managers will be able to add value is not just the packaging, because investors will be able to do it themselves, but in the curation, the figuring out what to package. Okay. That whether it is an active management or whether it is in the passive index approach. Also in the marketing of the assets. Right. That finance is a branch of marketing, and I know a lot of people in the industry don't want to admit that, but it is. And with literally tens of thousands of assets around the world to invest in, Last time I checked, there were over 50,000 common stocks and millions of bonds. How does an investor pick the stocks and the bonds and the alts and the coins and the other stuff to go into the portfolio? They need a lot of advice. They need a lot of information. And this is where AI and technology can be really helpful in helping individuals to custom design their own asset mix. So the wealth managers that are able to use these tools will prosper, and those that aren't will probably go the way of floor brokers on physical exchanges.
And Colin, taking all of this, and in your role as a person, I don't know, you poacher turned gamekeeper turned poacher, and your role that you now have as a fund manager, how do you see this all coming together in the portfolios that you manage?
Great question. I think I'll piggyback on what Jim said. I think direct indexing is going to be fascinating. And I'll use the word indexing, like scare quotes on it. I'm not sure we can talk about indexing, but that direct access, and I think the future of asset management is going to be fundless. I don't think that's the structure that's going to make sense in a world where all these assets move on chain. And I think it's going to allow complete customization to an individual's portfolio. I mean, I think I'm going to get the stat wrong, but I think there are more ETFs in this country than there are stocks. And that's just Looney Tunes, right? I mean, that makes no sense at all. And this idea that one size fits all, or I need to have these same assets recomposed and put into these different ETFs so that I can get access to something, I mean, it makes no sense. Why not just have that directly in somebody's portfolio? They can express their preferences. It can be tax aware. It can be, socially or culturally aligned with whatever their personal preferences are. I think that's going to be fascinating. But I think we're also going to see this evolve in ways that we can't predict. I think when the internet changed a lot, that sounds like a flippant statement, but it didn't change finance that much. And when the internet was coming out, people were like, oh, cool, I can take the New York Times and I can put it on a computer. And I can just read the New York Times on a computer. That's not the cool thing, right? The cool thing is re-envisioning what news looks like, and now you have Twitter, or X, I guess now. And then mobile comes out, and now we have Uber. These are things you couldn't have predicted in 1994. And I think there's a lot of maxis floating around this space and the crypto side, Bitcoin maxis, ETH maxis. And I think to be a maxi on anything right now is just ridiculous, that you want to be nimble and dynamic, and things are going to change, and they're going to change quickly. And if you get too narrow, too convicted, too concentrated in anything in this asset class, that's going to be dangerous. So our portfolios that we run of crypto assets are very diversified, they're nimble, they're thoughtful, they're very evidence-based. We spend a lot of time researching the tokens that are out there, and there's actually quite a number of great tokens that you can go out and buy that have really great tokenomics. They have good teams that are trying to build real things. They have sound tokenomics. And if that network or that app are successful, that token will accrue value. Why not take advantage of that? Instead of just owning ETH or just owning Bitcoin. So we try to bring that to people's portfolios. Around all of those really high quality assets are a whole lot of very low quality assets that I think I would never want to touch. And we don't buy meme coins. There's a lot of vaporware. There's stuff that is been launched that has probably no potential future, and they still trade at high valuations. So there's some pretty neat opportunities here from our angle, where we can long the assets we really like, and now you have the opportunity to short assets that you don't like. Pretty amazing, right? This is early stage technology companies with the benefits of liquid portfolio construction. This has never happened before. So this is phenomenal opportunity. I think the last thing I would say is that, again, early stage technology companies with liquid benefits, a lot of investors cannot access Ribbit Capital, Benchmark, Sequoia, pick your favorite VC fund. And if you can't invest in the top decile VC funds, you don't really want to be in VC because the median fund doesn't return the fund. It's not really that great of an asset class. Which is maybe a bold statement. It's phenomenal if you get in the good funds. But what crypto provides is it's not tulip mania, right? That was a 1 year period. This is 16 years going on now with crypto. This idea that it's a pet rock or it's like Beanie Babies is ridiculous. This is a true technology. It's disrupting things. We're seeing it happen. Anybody who doesn't agree with that is just not paying attention. And why not drop some of this in your portfolio? And I don't need Ribbit or Benchmark or Sequoia's permission to get some of this disruption in my portfolio. I can just go buy crypto. So this like direct market access is like a pretty phenomenal setup for people's portfolios where they can now sprinkle in the exciting disruptive return potential of crypto and get some of that in their broader portfolio.
I'll piggyback on that, and then I'll take it down a different avenue. I definitely agree in terms of what we spoke about, the digitalization, what digitization has led to digitalization. DLT or blockchain is the next step in terms of the self-sovereignty attached to that. I mean, indexing is always nice. We all want index. We want to have something as index. Then again, like the flip side, and there's a part of the portfolio which should be an index. Flip side of that is index is very much average. Who determines what is actually in the index? How broad is that index? Yeah. You know, with technology having given us access, Kevin Kelly's 1,000 fans, Twitter, like I think I forgot the stat, but we're all like 8 links away from the President of the United States or something like that. Increasing crowdfunding platforms where you can get access to curators who create custom baskets. Technology, blockchain has enabled cheaper, better, faster, enabling us to empower ourselves, rightly or wrongly, to go down certain paths, to create our own portfolios, to be exceptional, whilst knowing that, you know, ultimately, most likely, most of us will be average.
And Conrad, one of the points that Aaron did touch on, and I wonder whether we can move to this bit as well. Aaron, you said that actually currently it's actually quite difficult to get some of this exposure. It's actually quite difficult to actually to bridge. I think the phrase you used was bridge TradFi with the crypto world or even the digital asset world. I don't, you know, with that sort of angle in mind, how do we see that progressing? You know, do we have to wait till all of this moves across? Will this be a slow shift? Will this be a build it and they will come? Will this be a, oh my goodness, actually we have to bring the industry kicking and screaming across to these new rails? What are the thoughts of the panel on that challenge, Aaron, which you articulated earlier?
Yeah, I think what I said earlier, I think we should focus on that all on-chain economy, and that's what we need to keep in mind. And I think this disconnect between TradFi and crypto, that will stay for a while. And it is because of custodians do not cover all the coins we want to buy. Not all our trading partners might, let's say, be equipped to buy all the coins we need. And I think this is one of the biggest hurdles, actually. The compliance departments at TradFi service providers struggle. If we buy Bitcoin, then our custodian needs to run a lot of compliance checks, but it's all done pretty manual, and maybe we have a slightly more old-fashioned custodian than in that regard. But this is what's taking a lot of time, and I personally would like to focus more on this on-chain world. So.
But I mean, same in terms of North Star. I think it'll take us some time to get there. In the interim, there will be those hybrid shops, let's say like us, which will then ultimately face the stiffer competition from the TradFi shops who come in, who, if I think about the asset class, ETF in the US, basically, you know, settlement T+2, who does the bridge financing for assets for that settlement period to merge crypto native ecosystem with a TradFi ecosystem. That's guys like us or other players who have to step in. What's the domain expertise that we have to, you know, bring to the table? We have to have an understanding of the smart contracts. What is the asset actually that is to be delivered, for example, depending on which ecosystem you have. Ethereum staking, unstaking, on-bonding period can be very variable. If you're an ETP issuer, it's a very neat, tight product. You have to stake. You want to try and, I mean, this is more Europe than it is US market structure, but it's coming. Have to up the staking ratio, right? That means you take more of the unbonding risk ultimately, where you will have to have someone who's able to understand what's happening underneath the hood, willing to underwrite the smart contract risks to avoid slashing, etc., to be able to be there and fund the unbonding period for the ETF to match the T-2 settlement times, right? On
the staking part, I think the most companies that reach out to us are staking providers and the ones that try to solve that. It's crazy. It's huge. It's a fantastic business, staking. It's pretty easy and you're making good money. But in these are real things that can happen.
Yeah, settlement risk. You know, in one hand, it's wonderful that in the future rails, if you have atomic settlement, things will be much quicker. But then, what do you do with how you currently fund that? right? Because you've got the meeting of two different rails going on, and you need something there to actually take that on. How do we? So summarizing so far, it sounds like we believe that, this will increase the investment universe. That's what I've definitely heard. We believe that increasing the investment universe is useful and positive for investors because it'll give access to more variety and more opportunity, although that comes with a health warning that know what you buy, potentially, and know what you put in there, potentially as well, because, everything that shines may not be gold, but you have the opportunity to do so. We believe that will be able to create potentially more balanced portfolios by giving you some of that different types of exposure. But we also think that, we also think that in the longer term, this might also give some new financial products. The ability to, as you say, microfinance something in a very short period of time, the ability to borrow. What do we, in the last sort of quarter of this panel before we take some questions from the audience, so it's a bit of a warning that some questions are coming, so please be ready to ask them. What do we see as some of the, Aaron, you gave us your thoughts already on some examples there of microfinancing loans, etc. I'd love to hear from the other panel members on what else do you think this might give us? What are you excited about that this might give us an opportunity to do, which we may not be able to do at the minute?
Well, I'm excited about market infrastructure, so I don't know if other people find it exciting or not. But a lot of it is based on old systems running on COBOL, that type of stuff. So the back office efficiencies that can be used to reduce cost, reduce time, are quite promising. But also, with smart contracts, we can have more complex financial products that do the things we want. Sort of to build on the microfinance idea, imagine a company issuing securities that are backed only by the sale of a particular product. So if you're a movie producer and you're coming out with the next Star Wars, you could basically have a security whose return is based only on that particular movie. You could have a mortgage-backed security that is essentially self-executing through a smart contract. The idea that you have the money coming in and going where it's supposed to without having to go through archaic back office systems. So I think there are a lot of these kind of applications that really aren't glamorous, but useful.
Great, brilliant. Colin?
Yeah, I'll hop on. I'm excited about a lot. I think that sitting here and envisioning what is potentially possible is really fun, and I hope everybody will do this because I think that's where the new inventions will come. But stuff that's happening today are stable coins, and I think that it sounds so boring. It's just the U.S. dollar. Most of the stable coins are backed by treasuries, by U.S. dollars. But I think Chad Cascarilla at Paxos has this line I love, which is the dollar's an amazing product with terrible distribution. And it's like, yeah, the global demand for dollars is immense because people are looking for some sort of stable currency. Most people don't have that benefit. They don't have access to bank accounts. There's a lot of unbanked or underbanked people. And the dollar stablecoin gives people the ability to cross borders seamlessly, instantaneously, for very low fee. That's revolutionary. And then you can add yield to that. And so there's several yield-bearing stablecoins that are coming out now where I can hold the stablecoin, get pretty close to wholesale yields on this, 4 or 5%, and then if I want to use that to buy something, I just go buy it, or if I want to use that to invest in something, I can go invest in that. And it's going to really reduce and almost eliminate, I think, the sort of investment and consumption gap that creates opportunities for banks just to sit on piles of cash and earn the yield. And I just don't think I think banks should be very, very worried about what they do. And I think this technology is very much going to disrupt a lot of financial institutions in ways we're not anticipating yet. But stablecoins are an obvious use case that are happening today, and I think are unlocking a lot of opportunity. So.
Conrad?
Yeah, and then I guess I'll take the crypto native end of that spectrum. I'll go with something like decentralized, deep in decentralized infrastructure, which is basically where you have a coin, generally it'll be a utility coin. its purpose is there to bootstrap a network and ensure everyone in the network has the same incentive systems. That can be applied to energy production, GPUs, etc. And it's there. It's a way for people who have idle infrastructure. For example, in the GPU example, if you're a gamer, you went out, you bought a gaming rig, you have GPUs which you don't need during the night. That's idle capital that you ultimately have, which is locked up. If you participate or you believe in the render ecosystem, that ultimately then allows you to, via capital commitment, you get coin, you're now incentivized, skin in the game. You take the GPU, you plug it into the ecosystem in terms of the network. Anyone who's then an artist, animation studio who wants to have anything rendered has two choices. Number one, send it to AWS, pay cost plus margin, or two, basically send it to render, basically pay the ultimate low cost, because ultimately the guy who bought the machine only cares about electricity plus. There'll be some on-chain reputation mechanisms to ensure that any kind of message received by a rendering network will come back the same quality as it would be from the AWS. And then you, as the artist or the animation studio, you pay the GPU user in render token, basically. And that's a nice way how you have something decentralized infrastructure. You coordinate it via the token, and you make it accessible digitally, basically.
Brilliant. Aaron, before we go to a question, anything you'd like to add from your thinking and your musing?
Maybe digital space missions, tokenized space missions. That would be cool if you could invest in
Okay,
that.
explain that one.
Yeah. I mean, I don't know. Maybe there's a specific space mission you could invest in it, and any economical benefits would flow out of it. You would enjoy your fair share as well. I think
High risk,
maybe
high reward.
very high risk. I think two other things are also very important, right? It's digital identity. That's something we will really need if we want to go to this full adoption. And we'll get there, but it's pretty complex to fix that. There are a lot of projects working on this. We're working with a few. One other thing is that everyone always talks about the fact that blockchains are so transparent, which is fantastic. I agree, till a certain level. I don't want everyone to know what I have or what I'm trading or whatever. And so privacy will be very important. Also from well, I see a question popping up over there. Indeed, GDPR. Think from an asset manager perspective. Think from how we need to have a best execution policy. We need to make sure that we trade in the best interest for all our clients, that we do not favor any account over another. How are you going to do that on blockchains?
Yeah. MiFID II. Exactly, and I think and that's why then you call Paul and the team to come and talk to you about Nightfall and things like that to do private transactions on public chains. Yeah, all brilliant challenges as well that we do need to address, and we need to figure out how we address them. Last 10 minutes, I wanted to quickly go to questions in the room. Oh, there's already a hand up right in front.
Yes. So
You have to wait for the mic.
they don't have the microphone, but maybe they can switch me on. They're going to give me a mic. All right. Hi, my name is Paul Brody. I'm from EY. I'm going to ask a question I'm most interested in. So, tokenization is going to create all this really cool stuff that individual investors and private offices and family offices can buy. But institutional investors are generally limited for alternative investments to about 15% of their total investable assets. To get access to the other 85%, you've got to meet a standard of like kind of a fiduciary responsibility. You have to show that the asset you are going to buy is a safe and reasonable investment, and it fits into your overall portfolio and strategy. What's it going to take, and how long is it going to take to get to that moment where we can access that 85% of the institutional capital that's for sovereign wealth funds and retirement funds and things like that?
Very good question. You want to kick it off, Jim? Okay,
I'll kick it off. Too long is the short answer. And if you look at the diffusion of any technology, whether it is electric motors in manufacturing plants, or as you pointed out, how long it took earlier for institutions to go from all bonds down to the 60-40, it takes time. As the old generation goes, no, we're not doing that crypto stuff, and younger people come in going, yeah, there are opportunities here. So it'll be a longer, slower slog than I think any of us would like. that I can't give an exact time frame, but it's just the natural conservatism of fiduciaries and institutions. I think that it will take some institutions that become the equivalent of the Yale Endowment, and they do really great stuff, and everybody wants to copy them. But even that will probably take the better part of a decade for that kind of copying to roll out.
Anybody else on the panel with thoughts, views on this point? No?
I think it depends what we're talking about. I think it's a great question, Paul. Like, are we talking about sovereigns and pension funds buying crypto, or are we talking about them getting comfortable holding digital assets, and whether that's just the wrapper for some other alternative? And Jim's right, it's going to be slower than it should be, but eventually we're already seeing it change, right? Every major institution has alts exposure, and that number is only going to go in one direction on a go forward, and it's just going to take time, and then there'll be a herd effect back, circling back, because they need to get returns, right? Many of these institutions are underfunded. They have to hit their return targets, and that's harder and harder by the day.
It's interesting, a story a wealth manager recently said to me when they had a family office in, was that the 70-year-old head of the family was the one pushing for the crypto exposure. Interestingly, was the story I was told by a CEO of a large wealth manager recently. So, Jim, it might not. I think it's spread more evenly on who's interested, sir. More questions from the audience. Anybody has any other questions from the audience as well? Or if not, I can even go to some. There's a question about liquidity from the online side, which we can go to as well. We have a question here from the front as well. Just wait for the mic, please, sir, just so we have everybody.
Thank you. It's Christoph again. When looking at our investment and trading behavior, a couple of points which are kind of contradictory, TradFi compared to the new world. So on the one hand, pre-funding is a key mechanism in blockchain-based trading. Nowadays, typically, as an asset manager, when being active, when purchasing Siemens shares, we are active for our funds on 25 marketplaces, really to capture the very best price. Same when selling. And when having pre-funding needs, this would mean in the new world, at every trading venue, I need to have inventory I potentially have to sell. So that's one topic where we still haven't found a solution, so pre-funding and how does our investment behavior work. And the second one is we are also focusing on tokenized money market funds nowadays. And on-chain, you typically have instantaneous settlement, meaning T0 liquidity. On the other hand, assets we are investing in, we do not have a stock of tokenized bonds as of now. So meaning we would invest in T0 settling or T3 settling bonds, and on the other hand, we guarantee our investors T0 settlement. In kind of normal market circumstances, and this will work, but just take a period of crisis as we've had it with COVID, when French asset managers had outflows in the region of 20 billion euros, and imagine in a crisis situation, you have a funding gap of 5 billion, 10 billion, even if it's only for 2 days. So this would also be a big issue. So these are currently small nitty-gritty topics we are looking at in the blockchain world.
Yeah, well, these are valid concerns, right? We see this too, and I think when we move to a more on-chain world, I think these borrowing and lending pools, they work pretty well, right? So that could solve part of this problem, at least. But yeah, I see your point. This is an issue, but in an all on-chain world, funding hopefully is not even needed anymore, right? So.
Yes, in the interim period,
Yeah.
It might be a problem.
No, you're right. It is. It will be a challenge. Yeah.
Yeah. Do you have a cash drag as well, right? Your cash is coming in, you're not investing and things like that as well?
Yeah, not per se, because and that's how it currently works as well. cash might come in later, but then we just make sure that whoever is buying into the fund would just pay the slippage. So that should not per se be an issue, but
Cool.
it's definitely something we need to address. Yeah.
Maybe one additional remark. You were mentioning, Paul, that you have, as EY, figured out savings of about 100 million euros on a yearly basis when going into the into stablecoin. And I think the combination stablecoin tokenized money market fund will be extremely powerful, because then you could make use of AI bots. So as soon as cash is kicking in, you automatically convert in a T0 world, in an atomic settlement world, into an tokenized money market fund, which by definition is yield bearing. And when you have cash needs, you can instantaneously sell this product and reconvert it in stable coins, which you might use for settlement purposes.
Yeah, this is spot on, because indeed the case for tokenized money market fund is super strong. And also, if let's say you can use that as collateral, it will also take pressure off these money market funds, right, in terms of redemptions.
Yeah.
So we could even maybe, well, this is very dangerous what I'm going to say, but we can maybe take a little bit more risk even in these structures, more yield. Think about, again, this investment app, which would also serve as a payment app. People will just, on a continuous basis, just hold a money market fund token. And indeed, the moment you want to pay the shop owner, indeed, something happens with this AI bot that it, within seconds, switches to fiat, which goes to the shop owner, basically. And no, it's a super strong case.
And I think that's already happening in quite a few markets. I think there are already people playing with payment rails into money market funds, and we are definitely involved in a money market fund as collateral for swaps. It's with some industry organizations that are already working on that as well. So that's it's pretty public stuff there, if I could put it that way. But I think that's where the power comes in, because if you can use collateral, money market funds as collateral as well, you haven't got the redemption challenge the other side when you're meeting your margin calls, and that becomes a very helpful step. Last 3 minutes, and I know Paul's looking at his watch. There's one question that did appear but disappeared, which I thought was actually quite interesting. I was going to close off with the panel, which was, given everything that we've spoken about, and I think I can't remember which of the previous panel members spoke about this, but the need for global, because this is a sort of borderless almost challenge. But at the moment, while we do have borders, which can limit us, what would be your ideal dream location? You would not a place now, but the characteristics of an ideal dream location you would have. Just name like 3 top things that you would look for, where you would want a jurisdiction, from a jurisdiction to go there to be able to set up your business to do what you're talking about. Yeah. Let's start with you at the end.
Clarity and stability.
Well, regulatory?
Clarity and stability in regime. I'll take the easy 2 ones off the, off the table as we go through this.
Conrad was fast off the mark there, I'm sorry. Yeah. Colin, how about yourself?
We have a global team from California to the Ukraine, but we set up in the US and are an SEC registered investment advisor, which took a lot of years off my life. I used to look like Brad Pitt before I tried to do that. I'm not even kidding. So that was tough, and it's been, but I think, we were like living in the freezer for 4 years, and I think that's changed in the States. So despite whatever else is happening, I think it's cool. Very positive in regards to clarity and open-mindedness and just acceptance of some disruption.
Yeah. In addition to what's been said about regulatory clarity, I would say rule of law with a judicial system that provides fast and efficient dispute resolution, because there will be disputes, and you want a predictable legal system that will give fair dispute resolution.
Very good. How about yourself?
A lot has been said already. I'm going to be a little bit more pessimistic in terms of regulation. I think, and I hope regulators will work together around the world, but I think it will still, from a regional perspective, a little bit siloed, to be honest with you. Also, if we see what's currently happening in the world, which is fine, but of course, at some point we hope regulators will work more together. But for now, I think we, as VanEck in Europe, we are happy to just focus on the European market.
Okay, well, thank you. Thank you very much, panel members, for your input and for your lively discussion, and for keeping to time. And we'll hand over to Paul to take us to the next session.